Wealth Attraction Research. WAR. WAR. Profits, pins, and shares. WAR. Wealth Attraction Research. Profits, pins, and shares. You're listening to Wealth Attraction Research. WAR. WAR. Profits, pins, and shares. Presented by Hakeem Alibokis Alexander on Spreaker, Social Podcasting, and Wisdom, Social Audio Inc. Presented for World Reading Club in association with UniquilibriuM. This edition's reading focus comes to us once again from The Wealth of Nations by Adam Smith, 1776, The Little Book of Economics, 2012 and 2020, and How Money Works, 2017. This is going to be a quicker reading, I believe, than the previous ones, which you can also find on both Spreaker and Wisdom. And I actually have to update those onto my, upload the ones from yesterday onto the podcasting site Spreaker, which I had to split those two yesterday into two different talks. One's an hour and 30 minutes, and the other one is an hour and 4 minutes in order to get through everything I wanted to get done. But this one should definitely be a little bit more brief. So in the spirit of getting it done, let's start with The Wealth of Nations, Adam Smith. This is chapter 9, and it's titled Of the Profits of Stock. Of the Profits of Stock. All right? Chapter 9, Of the Profits of Stock. The rise and fall in the profits of stock depend upon the same causes with the rise and fall in the wages of labor, the increasing or declining state of wealth of the society. But those causes affect the one and the other very differently. The increase of stock, which raises wages, tends to lower profit. When the stocks of many rich merchants are turned into the same trade, their mutual competition naturally tends to lower its profit, and when there is a like increase of stock in all the different trades carried on in the same society, the same competition must produce the same effect in them all. It is not easy, it has already been observed, to ascertain what are the average wages of labor even in a particular place and at a particular time. We can, even in this case, seldom determine more than what are the most usual wages. But even this can seldom be done with regard to the profits of stock. Profit is so very fluctuating that the person who carries on a particular trade cannot always tell you himself what is the average of his annual profit. It is affected not only by every variation of price in the commodities which he deals in, but by the good or bad fortune both of his rivals and of his customers, and by 1,000 other accidents to which goods, when carried either by sea or land, or even when stored in a warehouse, are liable. It varies, therefore, not only from year to year, but from day to day and almost from hour to hour. To ascertain what is the average profit of all the different trades carried on in a great kingdom must be much more difficult, and to judge of what it may have been formerly or in remote periods of time with any degree of precision must be altogether impossible. But though it may be impossible to determine with any degree of precision what are or were the average profits of stock either in the present or in ancient times, some notion may be formed of them from the interest of money. It may be laid down as a maxim that whatever a great deal can be made by the use of money, A great deal will commonly be given for the use of it, and that whatever little can be made by it, less will commonly be given for it. According, therefore, as the usual market rate of interest varies in any country, we may be assured that the ordinary profits of stock must vary with it, must sink as it sinks, and rise as it rises. The progress of interest, therefore, may lead us to form some notion of the progress of profit. By the 37th of Henry the Eighth, all interest above 10% was declared unlawful. More, it seems, had sometimes been taken before that. In the reign of Edward VI, religious zeal prohibited all interest. This prohibition, however, like all others of the same kind, is said to have produced no effect and probably rather increased than diminished the evil of usury. The statute of Henry VIII was received by the 13th of Elizabeth, and it was a cap 8, and 10% continued to be the legal rate of interest until the 21st of James I, when it was restricted to 8%. It was reduced to 6% soon after the Restoration, and by the 12th of Queen Anne, to 5%. All these different statutory regulations seem to have been made with great propriety. They seem to have followed and not to have gone before the market rate of interest, or the rate at which people of good credit usually borrowed. Since the time of Queen Anne, 5% seems to have been rather above than below the market rate. Before the late war, the government borrowed at 3%, and people of good credit in the capital and in many other parts of the kingdom at 3.5%, 4%, and 4.5%. Since the time of Henry VIII, the wealth and revenue of the country have been continually advancing, and in the course of their progress, their pace seems rather to have been gradually accelerated than retarded. They seem not only to have been going on, but to have been going on faster and faster. The wages of labor have been continually increasing during the same period, and in the greater part of the different branches of trade and manufacture, the profits of stock have been diminishing. It generally requires a greater stock to carry on any sort of trade in a great town than in a country village. The great stocks employed in every branch of trade and the number of rich competitors generally reduce the rate of profit in the former below what it is in the latter. But the wages of labor are generally higher in a great town than in a country village. In a thriving town, the people who have great stocks to employ frequently cannot get the number of workmen they want, and therefore bid against one another in order to get as many as they can, which raises the wages of labor and lowers the profit of stock. In the remote parts of the country, there is frequently not stock sufficient to employ all the people, who therefore bid against one another in order to get employment, which lowers the wages of labor and raises the profits of stock. So see here, you have something that still continues to this day, as Adam Smith is pointing out, that we can see very clearly. Of course, if you're going to pay laborers or workmen more, then of course the company's profit, right, the profit from their stock is going to get lower because they have to pay more money to their laborers to get things done. So it should be obvious that is why a lot of the companies seem to want to keep their pay to the workers to as little as possible, because the more they have to pay to workers, especially, of course, various companies have obviously more than just one employee, then they have to multiply that increased wage by however many workers they have, and then, of course, that limits how much money they can make. Is that greed? Perhaps it is. Let's continue. In Scotland, though the legal rate of interest is the same as in England, the market rate is rather higher. People of the best credit there seldom borrow under 5%. Even private bankers in Edinburgh give 4% upon their promissory notes, of which payment, either in whole or in part, may be demanded at pleasure. Private bankers in London give no interest for the money which is deposited with them. There are few trades which cannot be carried on with a smaller stock in Scotland than in England. The common rate of profit, therefore, must be somewhat greater. The wages of labor, it has already been observed, are lower in Scotland than in England. The country, too, is not only much poorer, but the steps by which it advances to a better condition, for it is evidently advancing, seem to be much slower and more tardy. The legal rate of interest in France has not, during the course of the present century, been always regulated by the market rate. In 1720, interest was reduced from the 20th to the 50th penny, or from 5 to 2%. In 1724, it was raised to the 30th penny, or to 3 and 1/3%. In 1725, it was again raised to the 20th penny, or to 5%. In 1766, during the administration of Mr. Laverty, it was reduced to the 25th penny, or to 4%. The Abbé Terry raised it afterwards to the old rate of 5%. The supposed purpose of many of those violent reductions of interest was to prepare the way for reducing that of the public debts, a purpose which has sometimes been executed. France is perhaps in the present time not so rich a country as England, and though the legal rate of interest has in France frequently been lower than in England, the market rate has generally been higher, for there, as in other countries, they have several very safe and easy methods of evading the law. The profits of trade, I have been assured by British merchants who had traded in both countries, are higher in France than in England, and it is no doubt upon this account that many British subjects choose rather to employ their capitals in a country where trade is in disgrace than in one where it is highly respected. The wages of labor are lower in France than in England. When you go from Scotland to England, the difference which you may remark between the dress and countenance of the common people in the one country and in the other sufficiently indicates the difference in their condition. The contrast is still greater when you return from France. France, though no doubt a richer country than Scotland, seems not to be going forward so fast. It is a common and even a popular opinion in the country that it is going backwards, an opinion which, I apprehend, is ill-founded even with regard to France, but which nobody can possibly entertain with regard to Scotland, who sees the country now and who saw it 20 or 30 years ago. The province of Holland, on the other hand, in proportion to the extent of its territory and the number of its people, is a richer country than England. The government there borrow at 2%, and private people of good credit at 3%. The wages of labor are said to be higher in Holland than in England, and the Dutch, it is well known, trade upon lower profits than any people in Europe. The trade in Holland, it has been pretended by some people, is decaying, and it may perhaps be true that some particular branches of it are so, but these symptoms seem to indicate sufficiently that there is no general decay. When profit diminishes, merchants are very apt to complain that trade decays, though the diminution of profits is the natural effect of this prosperity, or of a greater stock being employed in it than before. During the late war, the Dutch gained the whole carrying trade of France, of which they still retain a very large share. The great property which they possess both in the French and English funds, about 40 millions, it is said, in the latter, in which I suspect, however, that there is a considerable exaggeration, the great sums which they lend to private people in countries where the rate of interest is higher than in their own are circumstances which no doubt demonstrate the redundancy of their stock, or that it has increased beyond what they can employ with tolerable profit in the proper business of their own country. But they do not demonstrate that business has decreased. The capital of a private man, though acquired by a particular trade, may increase beyond what he can employ in it, and yet that trade continue to increase too, so may likewise the capital of a great nation. In our North American and West Indian colonies, not only the wages of labor, but the interest of money and consequently the profits of stock are higher than in England. In the different colonies, both the legal and the market rate of interest run from 6 to 8%. High wages of labor and high profits of stock, however, are things, perhaps, which scarce ever go together, except in the peculiar circumstances of new colonies. A new colony must always, for some time, be more understocked in proportion to the extent of its territory, and more underpeopled in proportion to the extent of its stock than the greater part of other countries. They have more land than they have stock to cultivate. What they have, therefore, is applied to the cultivation only of what is most fertile and most favorably situated, the land near the seashore, and along the banks of navigable rivers. Such land, too, is frequently purchased at a price below the value even of its natural produce. Stock employed in the purchase and improvement of such lands must yield a very large profit, and consequently afford to pay a very large interest. Its rapid accumulation in so profitable an employment enables the planter to increase the number of his hands faster than he can find them in a new settlement. Those whom he can find, therefore, are very liberally rewarded. As the colony increases, the profits of stock gradually diminish. When the most fertile and best situated lands have been all occupied, less profit can be made by the cultivation of what is inferior both in soil and in situation, and less interest can be afforded for the stock which is so employed. In the greater part of our colonies, accordingly, both the legal and the market rate of interest have been considerably reduced during the course of the present century. As riches, improvement, and population have increased, interest has declined. The wages of labor do not sink with the profits of stock. The demand for labor increases with the increase of stock, whatever be its profits, and after these are diminished, stock may not only continue to increase, but to increase much faster than before. It is with industrious nations who are advancing in the acquisition of riches as with industrious individuals. A great stock, though with small profits, generally increases faster than a small stock with great profits. Money, says the proverb, makes money. When you have got a little, it is often easy to get more. The great difficulty is to get that little. The connection between the increase of stock and that of industry, or the demand for useful labor, has partly been explained already, but will be explained more fully hereafter in treating of the accumulation of stock. So there's a good point to focus on, right? It says, money, says the proverb, makes money. When you have got a little, it is often easy to get more. The great difficulty is to get that little. That reminds me of a book by a guy named, is it Stuart Wilde, I believe? I don't know if that's his name, but the book is called The Problem with Money is Having Some. And I think that's an interesting title. The Problem with Money is Having Some. And it's a great read. It's more of a personal development with a lot of metaphysics in that read. And it's very entertaining. The author is hilarious in how he writes. He's also, I believe, from England or somewhere in Great Britain, and he definitely has a great spin on what he's talking about. Let me see if I can pull this up here just for my own memory here. I think his name is Stuart Wilde, but I'm going to put in here let me see, Google, Mr. and Mrs. Google, let's see. The Problem with Money is Having Some. Let's see what comes up. Yep, Stuart Wilde. Stuart is spelled S-T-U-A-R-T, and Wilde is with an E at the end, W-I-L-D-E. Yeah, it's the Trick to Money is Having Some. That's what it is. That's what it's called. The Trick to Money is Having Some. Great book. And even like I was just saying, right, that he's kind of hilarious in the way he writes. It says here in one of the descriptions, it says, making money is not a serious business. It is a game that you play. And that's like from the beginning of that description on Amazon. Thrift Book says it's practical and makes perfect sense. The problem with other New Ageist books is that they make you believe that all you have to do is visualize. Goodreads says, in this book, Stuart Wilde shows you that money is merely a form of energy, and that the difference between having it and not having it is merely blah, blah, blah. All right. So that it was Stuart Wilde, I did remember correctly. So good read if you want to check that out. Continuing with Wealth of Nations and this particular chapter 9 of the Prophets of Stock. The acquisition of new territory or of new branches of trade may sometimes raise the profits of stock, and with them the interest of money, even in a country which is fast advancing in the acquisition of riches. The stock of the country not being sufficient for the whole accession of business which such acquisitions present to the different people among whom it is divided, is applied to those particular branches only which afford the greatest profit. Part of what had before been employed in other trades is necessarily withdrawn from them and turned into some of the new and more profitable ones. In all those old trades, therefore, the competition comes to be less than before. The market comes to be less fully supplied with many different sorts of goods. The price necessarily rises more or less and yields a greater profit to those who deal in them, who can, therefore, afford to borrow at a higher interest. For some time after the conclusion of the late war, not only private people of the best credit, but some of the greatest companies in London commonly borrowed at 5%, who before had not been used to pay more than 4 and 4.5%. The great accession, both of territory and trade, by our acquisitions in North America and the West Indies will sufficiently account for this, without supposing any diminution in the capital stock of the society. So great an accession of new business to be carried on by the old stock must necessarily have diminished the quality or the quantity employed in a great number of particular branches, in which the competition being less, the profits must have been greater. I shall hereafter have occasion to mention the reasons which dispose me to believe that the capital stock of Britain was not diminished even by the enormous expense of the late war. The diminution of the capital stock of the society, or of the funds destined for the maintenance of industry, however, as it lowers the wages of labor, so it raises the profits of stock, and consequently the interest of money. See, so again we have the same balance that's been played out for centuries and centuries, right? Which is that, he says, the diminution of the capital of stock of the society, or the funds destined for the maintenance of industry, right? Meaning the lower stock that it has, or the less funds destined for the maintenance of industry. However, it lowers the wages of labor, but it raises the profits of stock. You know, again, why so many companies want to keep the wages that they pay to workers down, because it raises their stock. By the wages of labor being lowered, the owners of what stock remains in the society can bring their goods at less expense to market than before, and less stock being employed in supplying the market than before, they can sell them dearer. Again, the word dearer means you can sell them for more, right? So, and why? Because less stock being employed in supplying the market, right? The stock being the things that they have to be able to sell, right? The less of them that is employed supplying the market than before, they can sell them dearer, right? Supply and demand, once again. The less there is, the more people are asking for them than is available, and therefore they raise the prices. All right, so their goods cost them less, and they get more for them. Look at that. So it costs less for the goods. Why? Because they're lowering the wages of what they pay people to make those goods, right? So their goods cost them less, and they get more for them. So not only are they lowering how much they pay to people and getting the things to put in their stock, right, for less, but they're also charging more for them because of the fact that it's in high demand, because there's less of it. Their profits, therefore, being augmented at both ends, can well afford a large interest. And this is the large interest that you're talking about, is they can afford a large interest, meaning they can afford to pay more interest when they borrow, right? In order to get the funding that they need to hire the labor and to hire the materials and rent the land and pay the laborers to produce their stock, right? So they can afford to pay more interest. The great fortunes so suddenly and so easily acquired in Bengal and the other British settlements in the East Indies may satisfy us that, as the wages of labor are very low, so the profits of stock are very high in those ruined countries. The interest of money is proportionably so. In Bengal, the money is frequently lent to the farmers at 40, 50, and 60%, and the succeeding crop is mortgaged for the payment. As the profits which can afford such an interest must eat up almost the whole rent of the landlord, so such enormous usury must in its turn eat up the greater part of those profits. But the fall of the Roman Republic, a usury of the same kind seems to have been common in the provinces under the ruinous administration of their proconsuls. The virtuous Brutus lent money in Cyprus at 8 and 40%, as we learn from the letters of Cicero. In a country which had acquired that full employment or that full complement of riches which the nature of its soil and climate and its situation with respect to other countries allowed it to acquire, which could therefore advance no further, and which was not going backwards, both the wages of labor and the profits of stock would probably be very low. In a country fully peopled in proportion to what either its territory could maintain or its stock employ, the competition for employment would necessarily be so great as to reduce the wages of labor to what was barely sufficient to keep up the number of laborers, and, the country being already fully peopled, that number could never be augmented. So, this is another thing, right? In a country fully peopled in proportion to what either its territory could maintain or its stock employ, the competition for employment would necessarily be so great as to reduce the wages of labor. Again, that means when there's high unemployment because there's so many people seeking jobs, of course, once again, they'll pay the workers less because they're desperate for jobs because there's so few of them available. Continuing. In a country fully peopled in proportion to what either its territory could maintain or its stock employ, the competition for employment would necessarily be so great as to reduce the wages of labor to what was barely sufficient to keep up the number of laborers, and, the country being already fully peopled, that number could never be augmented. In a country fully stocked in proportion to all the business it had to transact, as great a quantity of stock would be employed in every particular branch as the nature and extent of the trade would admit. The competition, therefore, would everywhere be as great, and consequently the ordinary profit as low as possible. Right? So, of course, if the place has so many people that all of the businesses have filled up all the positions they have and therefore can produce a lot more, their profits are still low. Where in the other case of lowering the wages of people, because there were so many people, but there's so many people unemployed that they're not buying anything, so their profits are still low. And I mean, all of this makes sense, but it's really great to hear it in such detail. Continuing, but perhaps no country has ever yet arrived at this degree of opulence. China seems to have been long stationary, and had probably long ago acquired that full complement of riches which is consistent with the nature of its laws and institutions. But this complement may be such inferior to what, with other laws and institutions, the nature of its soil, climate, and situation might admit of. Oh, by the way, of course, we have China among one of the BRICS nations, being BRICS, which is Brazil, Russia, India, China, and South Africa, is the conference that was held today. Again, where some speculate that, financial gurus and the like, that they're going to be instituting a new gold-backed currency, and also some digital currencies that are not keeping the American dollar as the world currency that's currently used. So this global currency is going to be both digital and probably backed by gold, as some speculate, but who knows? But that, just reading about China remind me of that's today. Okay. All right. But perhaps no country has ever yet arrived at this degree of opulence. China seems to have been long stationary and had probably long ago acquired that full complement of riches which is consistent with the nature of its laws and institutions. But this complement may be much inferior to what, with other laws and institutions, the nature of its soil, climate, and situation might admit of. A country which neglects or despises foreign commerce and which admits the vessels of foreign nations into one or two of its ports only cannot transact the same quantity of business which it might do with different laws and institutions. In a country, too, where though the rich or the owners of large capitals enjoy a good deal of security, the poor or the owners of small capitals enjoy scarce any, but are liable, under the pretense of justice, to be pillaged and plundered at any time by the inferior mandarins, the quality of stock employed in all the different branches of business transacted within it can never be equal to what the nature and extent of that business might admit. In every different branch, the oppression of the poor must establish the monopoly of the rich. By engrossing the whole trade to themselves, will be able to make very large profits. Again, look at that, right? Same thing we have over and over again, like with the book of Robert Kiyosaki called Fake. Fake teachers, fake money, fake teachers, fake assets, while the poor and middle class, why lies are keeping the poor and middle class poorer. Which earlier in this book, The Wealth of Nations from 1776, talked about the secrets being kept by those in big business. So again, in every different branch, the oppression of the poor must establish the monopoly of the rich, who, by engrossing the whole trade to themselves, will be able to make very large profits. 12% accordingly is said to be the common interest of money in China, and the ordinary profits of stock must be sufficient to afford this large interest. A defect in the law may sometimes raise the rate of interest considerably above what the condition of the country, as wealth or poverty, would require. When the law does not enforce the performance of contracts, it puts all borrowers nearly upon the same footing with bankrupts or people of doubtful credit in better regulated countries. When a law does not enforce the performance of contracts, it puts all borrowers nearly upon the same footing with bankrupts or people of doubtful credit in better regulated countries. The uncertainty of recovering his money makes the lender exact the same usurious interest which is usually required from bankrupts. Among the barbarous nations who overrun the western provinces of the Roman Empire, the performance of contracts was left for many ages to the faith of the contracting parties. The courts of justice of their kings seldom intermeddled in it. The high rate of interest which took place in those ancient times may perhaps be partly accounted for from this cause. When the law prohibits interest altogether, it does not prevent it. Many people must borrow, and nobody will lend without such a consideration for the use of their money as is suitable, not only to what can be made by the use of it, but to the difficulty and danger of evading the law. The high rate of interest among all Mahometan nations is accounted for by Mr. Montesquieu, not from their poverty, but partly from this, and partly from the difficulty of recovering the money. The lowest ordinary rate of profit must always be something more than what is sufficient to compensate the occasional losses to which every employment of stock is exposed. It is this surplus only which is neat or clear profit. What is called gross profit comprehends frequently not only this surplus, but what is retained for the compensating such or extraordinary losses. The interest which the borrower can afford to pay is in proportion to the clear profit only. All right. Continuing, the lowest ordinary rate of interest must, in the same manner, be something more than sufficient to compensate the occasional losses to which lending, even with tolerable prudence, is exposed. Were it not more, charity or friendship could be the only motives for lending. Right, and this is what interest is, right? If you don't know, I mean, I think I've read it somewhere else before in one of these other books, but interest is simply to help to mitigate risk, right? So people pay these high interest rates in borrowing because some people may default, right? So, of course, if some people default on their loans, then that means that the lender is not going to get it back. And so everyone gets charged this interest while they're paying it back because of the fact that lending carries with it risk. And just like he said just now, that says, were it not more, meaning the interest rate, charity or friendship could be the only motives for lending. Charity or friendship could be the only motives for lending if the interest weren't sufficient to cover those sometimes seldom and sometimes often losses when people default on their loans. And that's what interest is for. In a country which had acquired its full complement of riches, where in every particular branch of business there was the greatest quantity of stock that could be employed in it, as the ordinary rate of clear profit would be very small, so the usual market rate of interest which could be afforded out of it would be so low as to render it impossible for any but the wealthiest people to live upon the interest of their money. All people of small or middling fortunes would be obliged to superintend themselves the employment of their own stocks. It would be necessary that almost every man should be a man of business, or engage in some sort of trade. The province of Holland seems to be approaching near to this state. It is there unfashionable not to be a man of business. Necessity makes it usual for almost every man to be so, and custom everywhere regulates fashion. As it is ridiculous not to dress, so is it, in some measure, not to be employed like other people. As a man of civil profession seems awkward in a camp or a garrison, and is even in some danger of being despised there, so does an idle man among men of business. The highest ordinary rate of profit may be such as, in the price of the greater part of commodities, eat up the whole of what should go to the rent of the land, and leaves only what is sufficient to pay the labor of preparing and bringing them to market, according to the lowest rate at which labor can anywhere be paid, the bare subsistence of the laborer. The workman must always have been fed in some way or the other while he was about the work, but the landlord may not always have been paid. The profits of the trade, which the servants of the East India Company carry on in Bengal, may not perhaps be very far from this rate. The proportion which the usual market rate of interest ought to bear to the ordinary rate of clear profit necessarily varies as profit rises or falls. Double interest in Great Britain reckoned what the merchants call a good, moderate, reasonable profit, terms which I apprehend mean no more than a common and usual profit. In a country where the ordinary rate of clear profit is 8 or 10%, it may be reasonable that one half of it should go to interest, wherever business is carried on with borrowed money. Right? So in a country where the ordinary rate of clear profit is 8 or 10%, it may be reasonable that one half of it should go to interest. Right? So again, if you're borrowing money at about 4 to 5%, right? So you borrow $100 and you got to pay back 5%, right? So now you're paying 105 back from that 100 that you borrowed, but half of that, because when you make that profit, right? So half of that you pay back so the profit. So it says in a country where the ordinary rate of profit, of clear profit, is 8 or 10%. Sorry, that's the profit there. So for the 100 that you borrow, you get 104 to 100. You get 108 to 110%, right, as a profit off of that. But half of that of that profit you pay back. So you're really only making 100 and yeah, 100 and four. Yeah, stock. Wait, where am I at here? Oh yeah, 8 or 10%, right? So it may be reasonable that one half of it should go to interest. So that profit that you're making off of that borrowed money, because that's what you borrow money for, and that's also another reason for interest, is because not only does interest help mitigate risk, but also you're paying interest because of the fact that you could potentially earn money from the money that you borrowed. As Adam Smith wrote previously, right? It says, as the saying goes, right? Where do you write exactly? He says, money, says the proverb, makes money, right? So when you make that 108, that $8, that $10 extra off every 100 that you've borrowed, half of that, so $4 to $5 goes back to paying the interest, because that's usually what the interest rates were. So again, here we go. So in a country where the ordinary rate of clear profit is 8 or 10%, it may be reasonable that one half of it should go to interest, wherever business is carried on with borrowed money, right? That's the whole point there, wherever business is carried on with borrowed money. The stock is at the risk of the borrower, who, as it were, insures it to the lender, and 4 or 5% may, in the greater part of trades, be both sufficient profit upon the risk of this insurance, and a sufficient recompense for the trouble of employing the stock. But the proportion between interest and clear profit might not be the same in countries where the ordinary rate of profit was either a good deal lower or a good deal higher. If it were a good deal lower, one half of it perhaps could not be afforded for interest, and more might be afforded if it were a good deal higher. In countries which are fast advancing to riches, the low rate of profit may, in the price of many commodities, compensate the high wages of labor and enable those countries to sell as cheap as their less thriving neighbors, among whom the wages of labor may be lower. In reality, high profits tend much more to raise the price of work than high wages. High profits tend much more to raise the price of work than high wages. Interesting. Raise the price of work than high wages. So, interesting. If in the linen manufacture, for example, the wages of different working people, the flax dressers, the spinners, the weavers, etc., should all of them be advanced 2 pence a day, it would be necessary to heighten the price of a piece of linen only by a number of 2 pences equal to the number of people that had been employed about it, multiplied by the number of days during which they had been so employed. The part of the price of the commodity which resolved itself into wages would, through all the different stages of the manufacture, rise only in arithmetical proportion to this rise of wages. But if the profits of all the different employers of those working people should be raised 5%, that part of the price of the commodity which resolved itself to profit would, through all the different stages of the manufacture, rise in geometrical proportion to this rise of profit. The employer of the flax dressers would, in selling his flax, require an additional 5% upon the whole value of the materials and wages. The employer of the flax dressers would, in selling his flax, require an additional 5% upon the whole value of the materials and wages would be advanced to his workmen. The employer of the spinners would require an additional 5% both upon the advanced price of the flax and upon the wages of the spinners. And the employer of the weavers would require a like 5% both upon the advanced price of the linen yarn, and upon the wages of the weavers. In raising the price of commodities, the rise of wages operates in the same manner as simple interest does in the accumulation of debt. In raising the price of commodities, the rise of wages, right? So in raising the price of things that you sell, the rise of wages, what people get paid, who made those things that you're selling, the people that you pay, operates in the same manner as simple interest does in the accumulation of debt. The rise of profit operates like compound interest. Our merchants and master manufacturers complain much of the bad effects of high wages in raising the price. and thereby lessening the sale of their goods both at home and abroad. They say nothing concerning the bad effects of high profits. They are silent with regard to the pernicious effects of their own gains. They complain only of those of other people. I mean, a lot of honesty there, right? And that's the end of that. That's the very end of that. All right. So we have the end of that, which is very, very, very enlightening here at the end of this chapter 9 of the prophets of stock. Right? Once again, I like this. It says, our merchants and master manufacturers complain much of the bad effects of high wages, right? Because the high wages in raising the price, right? And thereby lessening the sale, because they're more expensive, right, of their goods, both at home and abroad. But, as he continues, says, they say nothing concerning the bad effects of high profits, right? And what are those bad effects of high profits, right? Well, the effects of high profits, then, because of the fact that they lower wages of people, right, is the bad effect it has on the people hardly being able to buy their own subsistence, right? But they say nothing concerning the bad effects of high profits. They are silent with regard to the pernicious effects of their own gains. They complain only of those of other people. They complain only about the gains of other people. Fascinating. This book is really great. The Wealth of Nations by Adam Smith, 1776, which, as you'll see, he's mentioned again in a book that was published both in 2012 and updated again in 2020. That is coming up next, The Little Book of Economics. You're listening to Wealth Attraction Research, WAR, War, presented by Hakeem Ali Bokus Alexander. It's called Profits, Pins, and Shares, presented on Spreaker, Social Podcasting, and Wisdom Social Audio Inc., presented for World Reading Club in association with UniquilibriuM. The next part of this reading focus comes to us from the Little Book of Economics, and it is titled, Divide Up Pin Production and You Get More Pins, Division of Labor. If you had heard any of my reading from the Wealth of Nations before, you'd have heard about that. So let's take a look. Continuing. This is from the Little Book of Economics, the second part of the reading here for Wealth Attraction Research, and in context, focus, markets and firms. Key thinker, who did we just read from? Adam Smith, born 1723, died 1790. Before him, in 380 BCE, before Common Era, in the Republic, the Greek philosopher Plato explains how a city emerges and then grows by exploiting the gains made by dividing labor. 1705, Dutch philosopher Bernard Mandeville coins the term division of labor in his The Fable of the Bees. And after that, after the key thinker Adam Smith in 1867, Karl Marx argues that division of labor alienates workers and is a necessary evil that will eventually be suspended. Right? Remember Karl Marx, which I have his book in which he probably says that is the Communist Manifesto. And also after Adam Smith, you have 1922 Austrian economist Ludwig von Mises argues that division of labor is not alienating but brings huge benefits, including greater leisure time. All right. Continuing, divide up pin production and you get more pins, the division of labor. Whenever people work in a group, they invariably start by deciding who is going to do what. It was the great Adam Smith who turned this division of labor into a central economic idea. At the very start of his influential book, The Wealth of Nations, Smith explains the differences between production when one person carries out the full sequence required to make something and when several people each do just one task each. Writing in 1776, Smith noted that if one man set about making a pin, going through the many steps involved, he might make perhaps not one pin in a day, but by dividing the process among several men, with each specializing in a single step, many pins could be made in a day. Smith concluded that the division of labor causes, in every art, a proportionable increase in the productive powers of labor. So the division of labor causes, in every art, a proportionable increase of the productive powers of labor. And we got a little picture here that shows some folks working in a stockroom, and its caption reads, "In a busy stockroom, labor may be divided between porters, inventory clerks, a manager, accountants, distribution specialists, IT workers, and truck drivers." Continuing, the engine of growth. Smith was not the first to appreciate the value of the division of labor. About 2,200 years earlier, Plato had argued that a state needs specialists. Wow, that's a long time before 2,200 years earlier. Plato had argued that a state needs specialists, such as farmers and builders, to supply its needs. The Islamic philosopher Al-Ghazali, from 1058 to 1111, noted that if we take into account every step involved in making bread, from clearing the weeds in the fields to harvesting the wheat, we would find that the loaf takes its final form with the help of over 1,000 workers. Many early thinkers linked division of labor to the growth of cities and markets. Some thought that the division of labor caused the growth, while others proposed that the growing cities allowed the division of labor. What was groundbreaking about Smith's ideas was that he put division of labor at the heart of the economic system, insisting that it is the engine that drives growth. The more specialized the workers and businesses, the greater the market growth and the higher the returns on investments, which is one of the reasons why businesses make so much profits, as is seen from experience. When you divide the labor, when people do different jobs working with each other, then things grow more. Even if you don't have employees, like I would just work with contractors that do different things with me, not for me, because they're own specialists at the things that they do, and I specialize simply in the communication, administration of the things. It makes things run much easier than if I were to have to do the scheduling, and also making the contracts with the martial arts studios, and making sure that they have all of the different kinds of cleaning supplies, as well as setting all the standards and things like that. If I had to do that and then go clean the studios, I would be a lot less efficient at what I'm doing. But since I only have to handle that administration and planning and scheduling, and then the cleaners do their job and they don't have to do the planning and scheduling, then things go a lot more smoothly. Division of labor. All right. There's a flow chart here that shows the first bubble says when workers concentrate on one task. On the left it says repetition increases skill and speed, right? So everybody knows that, right? You know that repetition increases skill and speed, so you get better the more you repeat something. It's a physical form of hypnosis, or a physical form of learning, right? Conditioning. On the right it says no time is wasted through switching between tasks, right? And this increases production cost and reduces cost. This increases production and reduces costs, which leads to divide up pin production and you get more pins. Continuing, a necessary evil. Karl Marx saw the power of this idea, but believed that the division of labor was a temporary, necessary evil. Specialization alienates, condemning workers to the dispiriting condition of a machine performing repetitive tasks. He distinguished between the technical division of labor, such as each specialized task in house building, and social division, which is enforced by hierarchies of power and state. Labor division is the norm within most companies today. Many large corporations now outsource tasks formerly carried out by their own staff to cheaper overseas worker, giving the division of labor a new international dimension. Very true, right? Outsourcing, yeah. But as a lot of people know about the customer service being outsourced is one of them, amongst the other things that are not so good with the cheap labor in different countries that people call slave labor, or the sweatshops and all that. All right, but finishing out this section is a question. It says, all American jobs? When people working in industry worry about the strength of their home economy and rates of employment, they sometimes urge consumers to buy home-produced goods. However, it can be hard to know what is home-produced since division of labor has now become global in scope. For example, Apple is a U.S. company, so consumers might suppose that buying an iPhone, they are contributing to U.S. jobs. In fact, of all the processes involved in making an iPhone, only the product and software design and marketing occur primarily in the U.S. Notice the word primarily. Only the product and software design and marketing occur primarily in the U.S., right? Each iPhone is assembled by workers in China using parts such as the case, screen, and processor made by workers in South Korea, Japan, Germany, and 6 other countries. In addition, each of these parts has been assembled by a range of specialists around the world. The iPhone is a truly global product, made perhaps by tens of thousands of people. And we have a little image here where it says, assembly line workers in China build computer processors with components made in up to 9 different countries. So there's a division of labor as talked about by Adam Smith. I don't know if he knew that it would be so international in scope, but that was the section from the Little Book of Economics. Divide up pin production and you get more pins, the division of labor. All right. I just took a turn of the page, and the next thing I'm going to read in the next edition says, population growth keeps us poor, demographics and economics. That might not be such agreeable to a lot of people, especially those of you who have maybe heard some of the conspiracy theories about population control. But that's not the focus of this. This is the final part coming up here. You're listening to Wealth Attraction Research, WAR, War, Profits, Pins, and Shares, presented by me, Hakeem Ali Bokus Alexander, on Spreaker, Social Podcasting, and Wisdom, Social Audio Inc. And this last part comes from How Money Works, and this is a section called Shares. Shares, if you didn't notice. Today's title comes from all 3 of the different books because they seem to fit together really well. Profits, Pins, and Shares. Shares from How Money Works. Shares are units of ownership interest in a corporation that are available for investors to buy or sell. Companies create shares in order to raise capital, which they can invest to grow their business. How it works. Shareholders are investors who buy the shares a company creates, and who therefore own a part of the company. When shareholders buy a share, it is usually an ordinary share or common share, which means that they can vote in the election of the company's executive team, approve or vote against new share issues and other money-raising activities, and in some cases receive payouts known as dividends. Shareholders are entered on the company's shareholder register, which is a list of all the investors who hold a stake in it. Investors buy shares for capital growth, hoping the underlying value or price of the shares will rise, and for income if the shares pay dividends. Share prices rise and fall based on a company's financial performance, general economic news, and market sentiment, how investors feel about a company or the wider economy. If a share price fluctuates in a short space of time, it is said to be volatile. If one company's share price is volatile, it can indicate investor worries about that company. If volatility affects all share prices, it can indicate instability in entire markets. Need to know. And maybe I'll read that last. Let's take a look at the different parts of issuing shares here. So, issuing shares. Companies issue shares when they need money to invest or pay off costs. When an investor buys a share, they become a shareholder and own a small part of the company. And so we have a company, looks like a barrel with a spigot sticking out of it. There's a barrel here labeled company and has a little spigot sticking out of it. A company needs shares to expand its operation. It decides to offer shares to the public via flotation on the stock market. And then it shows this barrel on top of a perch, and its spigot is open, and it's pouring into these bottles. And the one of the bottles is labeled $10 per share, and the bottles are in a rack. They look like wine bottles, and it's labeled company shares. Right? So the company issues shares at $10 per share. The shares are made available via an initial public offering, IPO, at an agreed price. Then you see this share in a person's hand, which is a wine bottle, being handed over to another person who's handing up a bag that says $1.33 on it. Let's see what that says. Individual investors receive their shares at the issue price, in this case $10. The shares can then be bought and sold on the stock exchange. Then we have these bottles in the stock. I wish you guys could see these pictures. It's great. This book is great. By the way, this book, How Money Works, it says the facts visually explained. All right, stock exchange, shares for sale. After the IPO allocations, right, the initial public offering allocations, the company makes the shares available on the stock exchange where prices are affected by market performance. After 6 months, the shares gain 10% in value. Shareholders who sell shares they bought at $10 now have made a profit of $1 per share. And that was shown, like the date, the month it was shown was in June. Now we look at December, and it says, after another 6 months, the company pays a dividend of $1 per share. Investors still holding their shares gain this $1 profit. And we have a need to know here list. It says listed. A share that appears on the register list of the stock exchange on which it is being traded, bought or sold. So traded simply means bought or sold. So listed, a share that appears on the register of the stock exchange on which it is being traded is called listed. Quote, the most recent price at which a share has been traded. Stock exchanges are now all electronic, and prices can be seen changing minute by minute during the course of the day. That reminds me of the scene in The Dark Knight Rises, where Bane went to go raid the stock exchange using the fingerprints that were stolen from Bruce Wayne. And a guy, one of the stockbrokers, walks up to him and says, "What are you doing here? There's no money. There's no money here. There's nothing to steal here." He says, "Then why are all of you here?" Right? All right, quote. Read that. The most recent price at which a share has been traded. Stock exchanges are now all electronic, and prices can be seen changing minute by minute during the course of the day. And finally, stocks. Stocks describes the ownership of shares in general. Stocks describe the ownership of shares in general. Shares refers to the ownership of shares in a particular company. All right. Stocks describes the ownership of shares in general, while shares refers to ownership of shares in a particular company. And that makes it more clear what Adam Smith talks about stocks. When somebody has stocks, right? Some stock means their ownership, they're the owner in the company. All right, understanding shares. Before I get to that, there's a number here that says the average daily trading value of the New York Stock Exchange, the largest in the world, is $169 billion. It's the average daily trading value, $169 billion. And finally, understanding shares. Once shares have been issued, they can then be traded on the stock market. The price of a share favored by investors tends to rise. If investors lose confidence, the price tends to fall. The price of a share favored by investors tends to rise. If investors lose confidence, the price tends to fall. This is another thing also, which is specifically referring to shares, is the same thing in the market altogether, right? It's again supply and demand, right? If the price of a share favored by investors tends to rise, favored by investors means there's more demand for it, right? So it rises. If they don't want it, of course the price falls to encourage buying more of them. If a company does well, shareholders share in the returns. This is what makes buying shares so exciting to investors. Shareholders buy part of a company. If share values fall, there is no guarantee that they will get their money back. If a company goes bust, shareholders will probably lose most or all of their initial capital. If a company fails, shareholders lose their investment, but they are not responsible for a company's debts. Right, so that's a good thing about owning shares, is that you might lose money by investing, but at least you won't be responsible for their debts. So you can own part of the company, but you're a shareholder, so you won't be responsible for paying shit that they owe if they fail. And that's it. You've been listening to Wealth Attraction Research, presented by Hakeem Ali Bokus Alexander on Spreaker Social Podcasting and Wisdom Social Audio Inc., presented for World Reading Club in association with exercisingyourmind.com and UniquilibriuM. Coming up soon is going to be the finishing up of part 3 of Babylon's Banksters. So that's sort of a supplement and a little bonus here, covering what some might say are conspiracy theories, or even some deeper high finance going on. The book Babylon's Banksters is subtitled The Alchemy of Deep Physics, High Finance, and Ancient Religions.